What's going on, guys? It's Investing Hustler here, and today I'm going to be talking about two stocks that I'm going to be looking at for 2018. Yeah, that's right, only two. Usually I do 3 or 5, but I don't have a lot of time right now, so this is going to be a very quick, straight to the point video of my top 2 stocks. Also, guys, don't forget 2018 has been a very volatile year, so you've seen a lot of red days, you've seen a lot of green days. So if you do invest in a company, make sure you do your homework and don't just invest in a company because someone else is doing it, because a lot of people are gonna get burned that way. If you do decide to invest in a company, do it because you believe in that company and you've done your homework in that company and you see a lot of potential for growth. So if you're going into 2018 with the same investing mentality of 2017, then you have another thing coming. So I'm gonna jump straight to the point. One of the companies that I'm looking at is Verizon Wireless, ticker symbol VZ. So Verizon Wireless has posted first quarter results on Tuesday, and their results were better than expected. They have beat earnings and revenues. Also, they have big plans for the future, announcing their goals to have 5G cellular service in 12 cities in the US before 2018. Verizon also has a PE ratio of 6.96, and when you compare that to a company like Amazon, which has a PE ratio of over 250, that sounds like a bargain to me. Another great thing about Verizon is they offer 4.85% dividends, which is amazing when you compare that to a company like Apple, which only offers 1.4%. I think at this moment Verizon is overbought due to its good earnings, but I do see a lot of potential for this company growing in the future, so I will be keeping an eye on Verizon. So what's there not to like about this company? They just announced good earnings, they have a really good PE ratio, they offer good dividend payments. The only thing I don't like about it right now is that they're kind of overbought because of earnings, which is expected. And number 2 is kind of like the complete opposite of Verizon, and it's Sony. And they just reported losses and they just took a big hit in the market. So right now, if you look at this charts, Verizon's going up, Sony's going down. So why would I consider a company that just reported losses? I'm not saying to purchase Sony right this very second. Sony is a company that just released very bad earnings and they just took a 7.65% hit in one day. So right now I'm kind of on the sidelines, just looking in at Sony, just trying to see how low it will go, and if they go below $42, I am going all in. Just kidding, but I will be starting a position with Sony if they go below $42. Also, Sony's PE ratio is a little bit worse than Verizon's. They have a PE ratio of 12, which once again, if you compare that to a company like Amazon with a PE ratio of over 250, 12 sounds like a very good number. Sometimes, like I said, you got to get knocked down to build back up. So this was a bad quarter for Sony. It's not like they've been having consistent bad years. Last year was a good year for Sony. They released record numbers. Also, another speculation is the PlayStation 5 will probably be released within the next 2 to 5 years, so that will probably drive the share prices up. So Sony has a lot of potential, especially if it goes below $42. I see that as a bargain. Pretty much it for Sony. I don't really have much good news for them, especially after their bad earnings, but like, this is a company that I see a lot of potential for growth. Once again, like I said, there are two complete opposite companies. They're both high risk, they both have fairly good PE ratios, but sometimes PE ratio could mean nothing, because a company with a high PE ratio could just mean that investors see a lot of potential and a lot of growth in that company. So that's why Amazon has a PE ratio of over 260, because investors see a lot of growth in that company, which I don't blame them, because Amazon has pretty much taken over. A lot of retail companies, I would stay away from them, especially since Amazon seems to be eating up all their competitions. A lot of retail stores like Walmart, Skechers. I did see a lot of potential in Skechers, but after hearing Amazon's earnings, which Amazon just released amazing earnings beyond what anyone expected. So after seeing Amazon's earnings, I would stay away from any retail stores. I wouldn't invest in them, but that's me personally. Verizon and Sony, I would say Verizon's a bit of a safer route and Sony's a little bit more risky. That's it for now. Make sure you do your homework before you invest. One piece of advice I'd give any investor is don't invest on green days. So when the market is doing good, don't just buy shares because the market is doing good, because from what I've seen and what I've experienced, right after you have a very nice green day, you see a very scary red day. If you enjoyed this video, don't forget to leave it a thumbs up. If you're not subscribed yet, then what are you doing? Smash that subscribe button. And that's it for now. Bye.